Hey, what's up, everybody? It is Wednesday, March 16th, Fed Day. It already happened. So, after a long period of anticipation, the Fed finally raised interest rates for the first time since December 2018. And the market went way up. We had almost a 4% rally in the NASDAQ. Dow was up. Everything was up. There was a brief moment when stocks started to sell off. I sent out an email right away to my subscribers saying buy that dip. And that's what you have to understand. I'm going to break everything down, but I think for those of you who have been following my channel and listening to me for a long time, you probably know where I stand on rate adjustments, and you probably know where I stand on Fed meetings. I basically ignore them. I pretty much ignore monetary policy, because if you understand what monetary policy is, it is price setting and it is income redistribution. So on the one hand, price setting, when the Fed adjusts rates, it either raises the general price level in the case of a rate increase because the cost of credit is reflected in the cost of all goods and services, or when it's a rate cut, it lowers the general price level because, again, the cost of credit is reflected in the cost of all goods and services. A rate increase is also a fiscal expansion because it necessarily involves the government paying more interest. That's interest income that flows into the economy. Of course, it's not all distributed equally. Some people get it and others don't. I don't make policy. I don't make the rules. Personally, if it were up to me, I would keep the rate at zero permanently. There's no reason why the government should be paying interest on its own money, and especially when you consider the fact that those interest flows really go to the top strata. You know, they go to the banking system, they go to financial institutions, and they go to wealthy individuals. And I just think that is a poor fiscal policy. All right. So that's basically what it boils down to. Now, why did the market rally? I saw one funny tweet. It was from a CNBC. I guess it was after the Fed decision. They had the panelists on CNBC. I wasn't watching the show, but I saw it was somebody tweeted it. And Steve Leisman, who I guess is CNBC's chief economic correspondent, whatever you want to call him, I don't know. He's like, I have no idea in the world why the market rallied. I mean, this again, folks, this is why I don't watch any of these financial TV shows. I spent 10 years at Fox News, even before Fox Business, and I was on Fox Business too when they launched that. And I just got sick and tired of dealing with morons who have no comprehension of the monetary system, economics, and just debating people. So you have this guy, Steve Leisman. He's been there a long time. If you watch CNBC, you know who I'm talking about. I'm sure he's very, very well paid. You know, they send him all over the world on when there's important meetings or things that he has to cover. Look, I mean, I don't even know what to say about this. This was so, first of all, this was so baked in. The market has been anticipating. I mean, how long have we been hearing like there's going to be 7 rate hikes this year? You know, the bond market has already raised bond yields up to the level that projects out. You know, it's already built into the term structure right now. I mean, if you look at bond yields right now, the Fed is going to be raising rates 7 times into early next year. And basically, you're going to be looking at a 2% to a 2.25% Fed funds rate based on right now. That's what the Fed funds futures are pricing in, that probability that, that we're going to see. So the market reflects that already. I mean, so all this buildup in anticipation just created a lot of worry and concern and negative sentiment, and then they raise rates 25 basis points, and yeah, it's a relief. And then we get back to what's really important, and that is the fiscal situation. And I've been saying now for the past two videos, if you've been following me, that by my calculation, and I could be wrong, but the most important thing to me was coming up with some way to quantify the impact of the sanctions, because that's something that can really impact the economy. And I said you have to look at bank residual, which is bank capital. That's what's going to take a hit, because like I said yesterday in my video, banks are very important pricing mechanisms. The banking system functions also as a price setter in the sense of how it values the assets that it is lending against. And I'm not going to go through all this again today on this video. If you want, just go back to my video yesterday and listen to what I have to say about that. And I came up with, basically a 5 trillion of asset capability. All right, the ability to hold 5 trillion of additional assets was taken away by the sanctions, and that was reflected in the decline in bank residual. Again, that's bank net worth. I'm not going to go over the whole thing again. You probably hopefully you listened to my video yesterday, and you know what I'm talking about. If not, go back and listen to it. Here's the other thing that's very important, which Leisman doesn't understand, and I would say 99% of the financial industry, analysts, economists, they don't get it, is that the Fed, has been needlessly, for the last, 2 years, pumping in $120 billion a month in reserves. Now, up until last March, if you recall, March 2021, that was not really an issue because they suspended the calculation or the use of reserves in the calculation of the leverage ratio. Remember that? And then last year, and I was talking about this a lot, and this was being pumped up big time, like on zero hedge and everything like that, how this was going to be a freaking disaster coming because they were not going to extend that exemption last March. And everybody, including guys like Zoltan Pozsar, who's like this newly established guru on the pages of Zero Hedge, he was saying there's going to be a massive crack up and this and that because all this reserve dump. And again, this is, it was exactly what I have been explaining for so many years, that these huge reserve additions, everybody always says, oh, they're pumping in money, they're printing, they're pumping money. No, that is an impediment, a huge impediment to banks' ability to make loans or acquire other assets. Because reserves are assets, and then when there's trillions being piled onto bank balance sheets, they're going to need more capital. So what happened was last year in March, remember the Fed came up with this very clever workaround with the reverse repos. They set up a facility where institutions can park their excess reserves in that reverse repo facility, and that effectively was able to drain or siphon off reserves from the system, and it allowed the banks to keep on going and making loans. But anyway, what I'm trying to say is the Fed's not buying $120 billion in assets anymore. Number one. Number two, they mentioned in their statement today that they were going to start reducing their holdings, which is even better. When the Fed buys these securities, the interest payments go to the Fed, not to the economy, and then the Fed just gives it back to the Treasury at the end of every year. It's like a stupid, shenanigan, shell game going on that we all think, oh, this is so, the debt, and it's so important. It's like comical. But now, the good thing is that those government securities are going to stay in the economy as opposed to going to the Fed, and the economy is going to earn the interest on that money. So again, there's that fiscal expansion going on. So all this stuff, I think, is bullish, number one. Number two, it is not going to reduce inflation because, again, every time they set the interest rate up, it just bumps the price level up. You know, and if they go slowly, it's not going to be that bad. But if they start to do like a Volcker, you know, insanity, jacking it up like mad, you eventually create a demand shock. And what that is when prices go up so fast that demand can't keep up. On that note, let me mention something, because today the weekly petroleum report came out from the Energy Information Administration. And what was surprising, three things were surprising to me. Number one, there was like zero impact on gasoline demand. Gasoline demand was steady in spite of the huge increase in gasoline prices. So that's number one. There was no demand destruction whatsoever. All right. Number two, U.S. oil production is still at 11.6 million barrels a day. I mean, that's 6 weeks in a row it's been steady, and we've seen a pretty big increase in rig count. So like all these people are saying, hey, we just got to produce more, including our current energy secretary. What's her name? I forget her name. It doesn't seem to be happening so easy. I said this before. It's not like, you know, flipping on a switch and now you're going to have more oil. I mean, 11.6 million barrels, despite the rise in prices and the increase in the operating rigs, it's not going up. And the other thing, which is, I mean, it just, when I look at it, I don't know whether to be like mad as hell. I don't know whether I should laugh my ass off or just, you know, be freaking incredulous at what's going on. We are exporting now. We are a net exporter. Crude exports are up 30% over last year. All right. Refined product exports, including gasoline and distillate diesel fuel, up like 32% over last year. I mean, here we are sitting here with this supposed, you know, oil crunch, and we're just sending our oil out to foreigners. I mean, this would be the easiest thing in the world for Biden to stop. Meanwhile, like, he bans the import of Russian crude, but at the same time, we are exporting our crude. We're exporting our gasoline. We're exporting our diesel. On a net basis, we are a net exporter. I mean, the numbers went up like huge in the latest week. So like, yeah, the oil companies are making a shitload of money and profit, but at the expense of Americans who have to fill their, you know, their vehicles up with gas. And by the way, let me just, you know, to be fair, this export policy was a policy that was put in place by Trump. He was the one who said, hey, we got to export. Yeah, we got to make money for the government, because he thinks the government needs to make money. Like, he's a businessman. That's the way businessmen think. That's why I always say you shouldn't have a businessman running the country, because government is different than private enterprise. But at the same time, Biden just lets this continue on and on. And we're literally exporting our oil at a time when supposedly we have this oil crunch. So, I mean, go figure. It's the craziest thing in the world. Anyway, that's the update for today. It's a bullish situation. Zelensky spoke to Congress today. Zelensky is demanding a no-fly zone. I was happy to hear that, you know, that's not on the table, but we are giving, you know, in the funding bill that Biden just signed, 1.5 trillion, is 14 billion that is going to Ukraine. Another billion was just earmarked today for Ukraine for weapons. Look, I'll make a personal statement. If Biden was a real statesman, a real leader, he would get involved with this and try to find a peace solution to both sides. Instead, he's fueling the conflict. It's a disaster for Ukraine. It's a disaster for the global, peace and harmony. It's a disaster for everything. If you want, a leader should be a statesman. Biden, being the leader of the most powerful country in the world, my opinion, he should step up and get involved and try to foment a peace agreement between both sides rather than fueling an ongoing war, which who knows how far it's going to escalate. It's disgusting in my opinion. Really is. Anyway, that's my little editorial at the end. All right, everybody. Enjoy. Bye.